Hey, it's Mark Zimmerman, President and Chief Operating Officer of Renters Warehouse Houston. We are a property leasing and property management company. I'm so glad that you decided to click on our video today. Today we're going to be talking about flipping versus renting, right? That typical buy, fix up, and sell, or buy and sell, however you want to do it, versus actually holding on to the property as a rental property. So to get right into that, renting really is the new owning. You know, the old American dream was that you buy a home, you live in it forever, and eventually you sell it or you die and your kids sell it after you pass on, right? That's the traditional American dream. Well, the new American dream is to buy and rent out multiple properties, so eventually they get paid off in the form of rent from your tenant, right? And now you've got financial freedom. Now you've got retirement security. You have something you can pass on to your kids. So that's kind of the old American dream versus the new American dream. So let's talk about traditional investing, right? Traditional investing, that's where you just buy it and you flip it. Maybe you fix it up, maybe you don't. But in this scenario, it's one and done, one and done, one and done. I can tell you I did that for 7-8 years. Was buying, fixing up, and selling 8 to 10 houses a month. And I basically left a really good job where I was working really hard to another job where I was working really hard, right? You're still having to work every day. And if you're not buying houses, you're not fixing up houses, you're not selling houses, well, then you're not making any money. So that's kind of the traditional investing model that you see on the Flip This House stuff on TV, where you buy, you fix up, and you sell, and then rinse and repeat. One of the reasons why you might want to avoid that now is there is some major declining home ownership. Yes, the market is hot, but as we'll talk about in another video, there's some interesting trends about home ownership, and one of the bigger ones is that even with the low interest rates right now, home ownership is declining. So might be a little harder to sell, maybe not in this hot market, but that's your traditional investing model. So renting, right? Your typical buy, fix up, and hold, or buy and hold. You know, what that's going to give you is that recurring revenue, especially after your mortgage, if you choose to finance it, leverage your money. Once that mortgage gets paid off, that's definitely great recurring revenue because the total amount of rent is going to go into your pocket now. There's no cash flow, which is a spread from what the rent is to what your expenses are. That cash flow is going to be really big now because it's all going to be going to your pocket with no debt service. The really nice thing about renting is it is skyrocketing in popularity. In fact, in that other trends video that we have as well, the trend is that there's going to be more and more people renting properties over the next 5 to 10 years just because the availability of properties are so much higher in cost that you can't even afford them with the lower interest rates. So the nice thing too about that is you've got a hedge against inflation when you own rental property, right? And you're using other people's money if you wish to go ahead and purchase it. So leveraging that dollar, which is nice. So really you've got 4 pillars of what we like to call financial freedom involving renting, right? There is the appreciation component, there's the tax break component, there's the equity component, and there's the cash flow component. So let's talk about the tax benefits first, that one of 4 pillars. Well, first of all, you're going to be able to deduct a ton of stuff when you own rental properties, which is going to help with the taxes that you owe. I would say that this is a great time to bring in a good CPA. There are great CPAs out there that are fantastic at helping you to identify what you can and cannot write off on your rental portfolio. But believe it or not, you can write off your mortgage interest. So your mortgage interest, if you do have any debt on that property, you can write off. You can write off the repairs. You can write off the maintenance. You can write off the leasing fee for a really good brokerage finds you a tenant. You can write off your property management fees that you pay every month. If you want to have a professional landlord, as I point to my shirt here, manage that property for you. You can write those fees off. You can write off taxes. You can write off insurance. You can even write off or depreciate the building. So there's tons of stuff that you can write off. Even travel to that property if it's in a different city. You can write off the travel expense to go see your rental property. So lots of tax benefits. Talk to your CPA. They're going to be able to really identify those for you and help you to save some money. The second pillar out of those 4 pillars of renting is equity. Now, equity is the difference between what your house is currently worth and what your mortgage is, what you owe on the property, right? So if you owe $150,000 on your mortgage and your home is worth $200,000, then you basically have $50,000 worth of equity. Makes sense? $200,000 what it's worth, $150,000 what's owed on it at the bank, $50,000 worth of equity. So here's the key part about equity. You can increase your equity in two ways, right? Number one, as the mortgage is paid down, the amount of equity in your home will rise. And again, in a rental property, for maybe not 100% of the mortgage, but for the majority of the mortgage, we hope, if your vacancy rates are low, who's paying your mortgage for you? The renter. That's right. So the renter is going to pay you rent. You're going to turn around and pay your mortgage. And if you put it on, say, a 15, 20-year note, in 15, 20 years, you got a house that's been paid off, and that equity is going to continue to increase as the debt service decreases as you pay off your note, right? Also, as the home value goes up, your equity is going to increase, right? You're paying off the loan, so that's going down. The house value is going up, so that's going up. Your equity now is increasing and increasing. So that's really the cool part. One of the second pillar of of the real estate model is that equity is going to help you so much. Fantastic. And get paid off by your tenant in terms of the mortgage. So the third pillar, right, that we're going to talk about is cash flow. Now, everybody talks about cash flow. We're going to talk about cash flow again when we talk about analyzing a property, if it's a good deal or not, the numbers, that's in another video. However, cash flow is very, very easy to calculate, right? It's very basic. It can be kind of incomplete, but here's how you calculate it. You take your monthly rental income minus your monthly expenses, and that equals cash flow. Pretty easy. So for example, let's say you've got a $2,000 rental, you got a $1,500 mortgage, you got $200 in property tax, and you got $100 in property insurance. And of course, I'm not taking out for your little maintenance that you want to apply, maybe $50, $100 a month. I'm not taking out a management fee if you're paying that. But there's a simple, easy one. In that example of $2,000 in rent, $1,500 cash flow, $200 property taxes, and $100 insurance every month, your cash flow for that property every month would be $200. So people look at the cash flow. Cash flow is great. If you get enough properties, your cash flow can really mean something, even if it's only $200, $300, $400 a house times 20 houses. That's not a bad little income on cash flow. However, once the debt service, your mortgage is paid off, now that cash flow is everything except for the insurance and the taxes, right? Which is a big, big number. So lastly, the most important pillar of the four pillars of renting real estate that I think of, and I think everybody agrees is the most important, is appreciation. Appreciation is simply your property's current market value, right? Or even more specifically, how much its value increases over time, right? So, for example, you got a house that's worth $200,000 today, at just a 3% appreciation rate, 3%, which, by the way, last year, or let's say this year, they're saying that Houston, if it tracks right, the Houston area is going to have a 19% appreciation rate for 2021. The actual appreciation rate for Greater Houston in 2020 was 16%. Now, Houston's been around 4, 5, 6% over the last 20, 30 years, right? You can always count about 5, 6% in Houston. Some areas more, some areas less, but yeah, 4, 5, 6%. In my example, at $200,000 at a 3% appreciation rate, which is extremely conservative, that means in 15 years, that house is going to be worth $311,000. You get that appreciation? Crazy. 3% appreciation rate. That house is going to appreciate from $200,000 today to $311,000 in 15 years. So appreciation is huge, huge. And in my example, that's $111,000 in appreciation over 15 years. Not bad. And that's at the little 3%. We're having double-digit appreciation last year and this year. So I bring it up because appreciation is really forgotten when people start analyzing their return on their rental property. Sure, they're figuring out what their yield is, and they go, "Well, Mark, I'm making 12%, yield on my property every year, which is okay, but not great." But everybody forgets the appreciation. So let's look at last year. You said you made 12% yield on your rental property last year when you did all your calculations. If you figure in that 16% appreciation rate, you actually made 28%. 28%. Even if it's, say, 5 or 6% on average, Figure that into your yield. If your yield again is 12% for the year, you got to throw in that extra 6%, let's say. Now you're looking at 18%. That's not a bad return on your money. So appreciation and equity are absolutely, in my opinion, the reason to hold rental property. Cash flow is nice, but really the big number is O&E. So think about that when you're looking at your investment opportunities and trying to decide if you're going to sell something or if you're going to hold it. Now, I think the big question that we always have to ask ourselves is this, why would you sell today for a one-time variable gain that's going to get gutted by commissions, it's going to get gutted by closing costs, when you can just hold on to that property and rent it and double, triple the value of your home over the certain amount of time? We're talking 15, 20 years. Why would you sell today for that one-time pop when you can have that pop every single month in your rental property? And if it's got a mortgage on it, get it paid off by the tenant and own it free and clear in 15, 20 years. And it's going to be worth a lot more, which means the rent's going to be higher. And now you've got something to leave to your children. You've got passive income, just like Rich Dad Poor Dad talks about. Mailbox money coming in every month because that house is now paid off, and that $2,000 rental, you're taking out a couple $300 for insurance and taxes, and another $1,700 is going in your pocket every month, and you got 10 of those. Now you're looking at $17,000 net. I mean, crazy. So think about all this before you decide to jump on the sales market. Is really hot right now and I can make some more money. I think you'll do yourself a favor by really investigating what holding that property and renting that property is going to do for you. And yes, there's headaches along with it. Yes, being a landlord sucks sometimes, but as I tell everybody, put on the blinders and just remember this: 70%, 80%, 90%, depending on your vacancy rates, depending on what any type of make-ready cost might be on every turn, whatever it is, somewhere between 70, 80, 90% of your mortgage is going to get paid off by a tenant in the rental model. If I said, hey, buy a house, and I got somebody over here that'll basically pay for 80% of that house, where you don't have to, they're going to pay for 80% of the cost of that house, you'd be like, sign me up. That's what being a landlord is all about, and you just have to keep those blinders on and tell you that when you have tenant troubles. Anyway, I hope this was valuable for you. If you have any questions, you can always reach out to us, but I appreciate all your time, and Mark Zimmerman, I'm out. Thanks for watching, everyone. We really hope you enjoyed the video. If you did, please hit the like button and subscribe below.